Hey, this is Felix with Belleville Real Estate. I'm a broker here in Houston, Texas. And today I'm going to be discussing the benefits of investing in commercial real estate, part two. And that is going to be appreciation. So, one of the main reasons why people decide to invest in real estate at all is because of the fact that it appreciates over time. And now, what appreciation means is the value of an investment going up over time. If I buy today at $100 and 100 years from now I can sell it for $200, then that's appreciation. I build appreciation over the years. The converse or the opposite would be depreciation. You buy something at a high price and over time it actually decreases in value. So that would be depreciation. The benefits of appreciation in real estate are really threefold. The first one is when you buy it at one price, just because the way real estate works, supply and demand happens in the market, the value of the property is going to go up even if it's small rate. So if you buy it today, a year from now, the property will be worth more at a market value if I were to sell. And so that's number one benefit of appreciation. Number two is that actually if a property goes up in value, now you can start demanding higher rents from your tenants, and this can turn into greater cash flow for the investor or the owner of the property. So if the property is worth today $100,000, a year from now maybe worth $120,000, and because of that spread of $20,000, I can demand for higher rents from my tenants. And lastly, the last one, benefit of appreciation. This is not so much related to appreciation, but more so with equity. And it's the fact that if I buy a property that's actually worth $100,000, but I buy it for $50,000 outright cash, no debt, the second I buy it and then the title gets transferred over to me, I have $50,000 of equity in the property, which means that I could literally, buy the property for today for $50,000 and then market it at a market price of $100,000 and make my spread of $50,000. That's called equity. And so when you start buying assets at lower price points that they're actually worth, you start developing automatic equity, and that's a great place to be. So now you may ask yourself, why or how can we cause appreciation? How does appreciation work? Well, there's four really main factors that are going to dictate how or what the value of properties are. The first one is just going to be basic supply and demand. Is your a specific type of property? What's the supply like? Is there a lot of inventory in the market? Okay, and now what's the desirability for this specific type of property right now? So, say right now, industrial real estate is probably the hottest that's ever been, and demand is really high, but inventory is also really low because everybody wants to hold on to theirs. And so a second factor would be actually location. Let's say a frontage property over on the highway, it's going to be worth more. Has the potential to appreciate more than a property off the highway, and this may be because of the accessibility. You have more views, and more cars passing through the property. You can gain more business this way. So this is going to be the second way. A third way is actually going to be the way that we treat the property or how we force improvements to the property. So for example, let's say my property is beaten up and I do a whole renovation of $30,000 into the property. It's going to look a lot nicer. The value is going to improve because not only the quality is going up, the building, but also the life of the building is also going to go up. I mean, this building is not going to last me 10 more years. It's probably going to last me 50 to 20. So the value inherently goes up. However, we must be cautious because not always, whenever we put a certain amount of money into a property in terms of improvements, that's not always going to correlate to this exact same amount in in value increase. Whether that be up or down. If I put $30,000 into a property worth of work, it may mean that I can sell for 30,000 more. It may mean that I can sell it for 60,000 more, or it may mean I can sell it only for 10,000, or it may not even be worth at all. And this is really depending on what the buyer's looking for. Or what the desirability in the market. If the market's looking for rundown properties that they can just fix them themselves, then that's what they're going to pay for. They're not going to pay the extra mile for that extra work that you did. So it may not always be worth it to do this. And the last one is going to be interest rates on the mortgages. And the reason why is because if the cost of money to borrow money goes up, now it's going to be harder for buyers to pay higher amounts. So it's inversely related. The higher the interest rates go up, the lower the price points are going to be, because of the fact that it's more costly to borrow money, and it's going to cost the purchaser actually more because of the whole interest and everything else over the lifespan of the loan than it would be to buy at a lower price. So these are some of the ways that we can force appreciation into our buildings, or how they're actually built into the buildings. And we can see below that in Houston, appreciation rates have been going up steadily, at least for industrial market. And we saw a peak last quarter of price per square footage for industrial properties. So if you guys want to learn more about appreciation, or you guys want to leverage these principles into your portfolio, please don't hesitate to give me a call. Thank you. Appreciate it.